Well, Credit Suisse is facing a crisis of confidence with widespread speculations on social media about the financial health of the Swiss giant. But rumors aside, let us put the facts in place first up. Fact number 1. The stock price of Credit Suisse is down 55% for the year, out of which 20% has happened in the last 1 month itself. This means that the market capitalization of Credit Suisse has slipped close to $10 billion. To put it in context, HDFC Bank's market cap is 9 times of that. Even others like State Bank of India, ICICI Bank fare much ahead. And if you're looking at an equivalent back home, Innocent Bank is closest with a market capitalization of $11 billion. Fact number 2. The credit default swap for Credit Suisse skyrocketed and is now trading close to 2008 levels. Simply put, credit default swap provides investors with protection against financial risks such as default. In normal parlance, it is like an insurance premium. We pay higher premium for higher the risk, and hence higher CDS represents high fear of risk in the system. Fact number 3. About the comment coming in from the Credit Suisse management with the CEO memo talking about how the global bank is at the critical moment and how employees should not confuse the stock price with financial health of the Swiss giant. Additionally, the bank seems to have reached out to key investors to assuage concern and is expected to announce a big restructuring strategy on October 27. Now that we've covered the facts, let's also talk about the reports which are adding to the nervousness in the market. Report number 1 is that Credit Suisse might be looking at exiting the US business. Report 2, which is working in minds of investors, is that the bank might be looking at additional capital raise. And the third report is that there might be a possibility of sale of some of its unit at throwaway prices in a fire sale. While this could be the cause of worry for shareholders, let's take a look at what experts and brokerage houses have to say. First up is the comment coming in from the global market commentator Mohammad Al Arian, and he says, I do not think this is a Lehman moment. Brokerage house Citi also says that this is not 2008, though only the brave heart should go ahead and buy Credit Suisse given the negative sentiment and the key execution risk. However, they do note that capital adequacy is highest amongst the peers and liquidity position is also quite healthy. Jeffrey says that stock now trades at 0.2 times price to book, and this compares with over 3 times which we have seen for average Indian private banks, the likes of HDFC Bank, Kotak Mahindra Bank, etc. Jeffries and Bank of America maintains a hold call and says that they have asset sales alone which are unlikely to be the solution of the potential capital shortfall problem, but could be a first step, and buy the bank some time until shares recover and the outlook gets a tad bit better. Even if you look at Bank of America, they have cut their price objective from CHF 6 to Swiss franc 5 on lower earnings and reiterated their neutral rating. And Bank of America believes that substantial downsizing, including through sales and exit, would have to be the key thing that the bank does, and this would affect materially the group's total funding needs, with the potential in turn to improve the debt funding costs. So all in all, have to say that Credit Suisse in a midst of a self-serving prophecy where the questions are being raised whether clients will look at exiting the wealth management business or not. But for now, the brokerages are maintaining a sanguine call on the counter.